interesting development given how long this has been going on for. So yes, keep a close eye on all of these cues in today's trade.
Well, absolutely. And let's get you some more news and updates. Then the European Central Bank cuts interest rates yet again as inflation slows and macro growth falters. The central bank, however, did not provide any clues towards what lies ahead, even as street factors in steady policy easing in the months ahead. The bank has lowered its deposit rate by 25 basis points to 3.5%. Following up on a similar cut in June as inflation is now within that 2% target as well. In fact, let's also listen into what ECB's President Christine Lagarde had to say then.
Domestic inflation remains high as wages are still rising at an elevated pace. However, labor cost pressures are moderating and profits are partially buffering the impact of higher wages on inflation. Financing conditions remain restrictive, and economic activity is still subdued, reflecting weak private consumption and investment. Staff project that the economy will grow by 0.8% in 24, rising to 1.3% in 25 and 1.5% in 26.
Okay, so that's the word coming in from ECB's Christine Lagarde, but we also caught up with Geoffrey Dennis, the independent emerging markets commentator, discussing the ECB's move to cut its key deposit rates, and he also touched upon the scope for interest rate cuts by the Federal Reserve as well. Let's go across and listen in to what he had to say.
I don't see a recession, frankly, in either of these two sets of economies, and I think, therefore, the ECB was right to cut by 25 basis points only today, and for Christine Lagarde to say that she would be data dependent and would go meeting to meeting, as opposed to giving the market any real outlook for the next several meetings at this point. I think there is much more scope for interest rates to come down more significantly in the US over the next 12 months than in Europe, or perhaps I should say than in the EU, the euro area. And therefore, I would not be surprised if they paused. It's very hard to make a call at this point because it will depend also on the macroeconomic data. But my guiding principle here is that interest rates in the euro area have got less distance to fall than they do in the US. That will push the dollar lower.
All right, well, that's a word coming in from Geoffrey Dennis, but let's keep it with the central bank activity this morning. Then interest rate cuts from the Bank of England next week look unlikely, but investors will be watching its September meeting for clues about future moves as well as a decision over the pace of its bond sales. Now, economists are now looking at the central bank holding rate steady at 5% after lowering from a 16-year high of 5.25% in August.
Okay, and let's shift focus back to the US. The number of Americans filing new applications for unemployment benefits has increased marginally last week, suggesting that layoffs remain low even as the labor market is slowing. Weekly jobless claims rose by just 2,000 to 230,000. Meanwhile, producer prices rose 0.2% in August, up 1.7% on a year-on-year basis amid a rebound in the cost of services. The combination of a fairly stable labor market and lofty inflation further diminished the chances of the Fed Reserve cutting interest rates by 50 bips. Although a rate cut from the Fed is imminent, questions arise on the quantum of the same. And to discuss more on this, we caught up with Anurag Singh, the managing partner at Ansett Capital. Let's go across and listen in to what he thinks could be the Fed's potential move in this upcoming meeting.
Between the 5.5 to the end state of 3.5 by 2026, there are about 8 rate cuts to go. And there is about almost a 2-year time frame for the Federal Reserve to achieve that. So any point expecting a 50 basis point unless there is a crisis is kind of wishful thinking. So I think I was not expecting market can make its conjectures. But yeah, of course, I mean, that's a reality check. It's out of the window. The dollar index and plus, other 6 currencies, how do they interact and behave? Much depends on relatively how other central banks are doing, because this time it was a global inflation and then the global rate hike, and then the ECB has already cut 50 basis point. I doubt dollar index will fall below 100 much because relative basis it is still doing well, right? And US economy is still the most robust, so US central bank has the best position to start the rate cut cycle. vis-a-vis other economies, especially European Union, right? So that limits the extent to which dollar can fall, right?
If you like this video, then like, share and subscribe to ET Now.